Are we seeing a new technology bubble? Or are the big US tech stocks a must-have solid core to any portfolio? Just look here at how the big 6 tech companies have smashed the S&P 500 since January. Known to the world as the FAANG stocks, these are Facebook, Amazon, Apple, Netflix and Google. But we're adding in Microsoft today too because there's no reason to exclude them.
All 6 of these big tech stocks have been kicking ass and taking names. If you'd only invested in these 6 big American stocks since the start of the year, your wealth would be up by 50%. In normal times, the biggest and safest companies are only expected to grow at a moderate pace, but the FAANG stocks don't seem to have read the rulebook.
Today, we're going to be looking at the FAANG stocks, where we see them going from here, and which ones offer the best value for buying. Let's check it out.
Welcome to moneyandshackled.com, the investment and finance channel and website that sets you and your finances free.
That was Andy and I'm Ben, and if you like what we say, hit the like button and click subscribe. Stake are sponsoring this video, so we want to give a special shout out to them. For those who don't know, Stake offers unlimited commission-free trading in real time and is FCA regulated.
Stake is fractional investing, so you can easily afford to buy highly priced stocks like Amazon and Google.
And Stake are giving away a free US stock worth up to $100 to everyone who signs up via our link. We'll put the link to the office page in the description below, so be sure to check that out. Now, let's get into the video. Dot-com bubble 2.0. Right now, tech stocks are everything, especially where software and the internet are involved. But we've seen this before.
In the late 90s, tech stocks were everything too. This is the Nasdaq Composite Index, the major US index which houses the bulk of America's tech stocks. We have to say this period here between mid-1998 and 2000 looks spookily similar to how 2020 has played out so far. And look what followed.
Back then, Cisco was the golden stock on everyone's buy list. But Cisco stock fell 86% in the dot-com bust of 2000. Little baby Amazon was there too, just starting out on its journey to dominate the world. And its share price suffered a similar correction. Amazon didn't fully recover for another 9 years. Its share price finally closed above its dot-com high in October 2009. And Amazon was the exception. Many dot-com stocks ceased to exist.
So what's different in 2020 to stop the same thing from happening again to our current batch of tech stocks? Well, a lot actually. The internet companies at the start of the century were priced based on the idea of a make-believe future rather than a proven track record.
The big tech companies of the year 2000 were only big because people assumed that the internet would swiftly become like it is today in 2020. All-encompassing, high street replacing, living in the cloud. It would take nearly another 20 years for that to happen, which brings us to 2020. Amazon, Google and the rest have now taken over the world and have multi-billion dollar research and development budgets. These companies are not going anywhere. Whereas, no one even remembers the big names of the dot-com bust. Boo.com, Webvan, North Point Communications. Who?
Helped by COVID. These are not normal times, and both the US stock market and tech sector have received abnormal inflows of investor cash as a result of the pandemic.
When everything crashed in March 2020, many people around the world became interested for the first time in investing. As the home of the world's best known companies, the US stock market gobbled up more than its fair share of retail investor cash, which helped to push up share prices across the board relative to other countries.
But it's also due to big tech, which is dominated by the FAANG stocks. Apple alone is now worth more than the entire FTSE 100. Technology has saved the world economy, while governments the world over may have inadvertently destroyed it with lockdowns. It was due to the existence of companies like Amazon and Microsoft that lockdowns were in any way sustainable at all.
The result of this is that once COVID and lockdowns are a thing of the past, so too might be the spike in demand for tech companies.
What if life doesn't return to normal? Let's talk about the cloud. AWS is a cash cow for Amazon. Amazon have been very busy onboarding thousands of smaller companies onto their cloud product, many of which will have started out selling their products through Amazon.
Large enterprises will be the next to move their operations to the cloud, and they are all already Microsoft customers. Microsoft stands to gain big time from this. The move to the cloud has been described as the fourth industrial revolution. COVID has sped up the need for it, along with the need for e-commerce.
Companies are rushing to retire their old infrastructure as quickly as possible to become more flexible so they can adapt to future crises and move with the times. We expect to see a continued move towards digital even if life returns to normal next year. They're doing this to future-proof against another COVID-esque scenario. And because companies have seen the incredible cost savings that come from not having to rent office space and own your own servers.
Accelerated progress. COVID has just accelerated what was already happening. A move to internet shopping, people working from home, the death of the high street, and more companies moving to the cloud.
But is the growth all over now? Have companies adapted to COVID, established their cloud tech and their working from home technology? Some analysts have been saying that COVID has simply brought forward future demand for tech products into 2020 and future earnings will now suffer. There's no argument that the FAANG companies skyrocketed through COVID and carried a lot of investors with them, but it's now the time to look ahead to the recovery and switch to value stocks.
The growth value gap. Tesla gets slated for being overpriced with a PE ratio of over 1,000. But are the FAANG stocks any cheaper? Yes, Google, Apple, Facebook, Microsoft, these all have PE ratios around the 35 mark, which while not cheap, is not ridiculously expensive. Then again, you have Netflix with a PE of 80 and Amazon with a PE of 100.
These are all great companies, but if you're interested in getting value for your money, then the first four are priced more sensibly based on current earnings. Normally, we look for PE ratios of 20 and under, but tech stocks are the exception to the rule. Good tech stocks are often found in the 30 to 40 range because of their earnings growth potential.
We think now might be a good time to look into the post-COVID future. As well as technology, the world is going to once again need airlines, hotels, and even banks once the economy picks up again. The value end of the market is the most likely to offer a good risk return. This is the part of the market for those who believe that the world will get back to normal.
They're already cheap, and if things even vaguely normalise, you're going to get a nice bounce. By buying FAANG, you're buying quality, momentum, and innovation, but not necessarily value for money.
A good company does not equal a good stock if that stock is priced many times higher than it should be. Would you buy a Mars bar for £5? A Ford Focus is a reliable car, but would you buy one for 50 grand? Is Netflix stock a good buy, even on an 80 times PE ratio?
Regulating big tech. One problem that could put the brakes on big tech is the growing demand for regulation of the industry. The EU, for example, hates the big US companies and is forever trying to tax and limit them. The UK government is also meddling with progress by floating the idea of taxing online sales in the hope that it drives people back to the high street.
And even the Donald has been banging the drum against US tech. But is this just a lot of hot air? It is in the US's interest for US companies to take over world markets. There's even a national defense argument. If the world grows to love American products and finds them essential, then it is less likely to side with China against America in any future confrontation.
The US is really worried about Chinese tech stocks like TikTok gaining too much influence abroad. So we believe that it's not in the US's best interest to over-regulate the FAANG stocks.
Where the FAANG stocks are going next. Number 1. Facebook. Facebook is arguably a very reasonably priced stock. It is currently running at a disadvantage during COVID relative to the other FAANG stocks.
Facebook gets its revenues mostly from brands advertising on their network, but companies the world over have had to slash their advertising budgets due to COVID. If things begin to pick up again next year, then Facebook will be in an even stronger position. We like the look of Facebook so much that we both bought more of this stock recently.
Number 2. Amazon. Amazon has done more than any other company to capitalise on lockdowns. It has kept us all entertained with its TV service, kept our cupboards stocked, and helped businesses to stay running with its cloud service. Amazon suffered a $6 billion cost of COVID this year, but saw an additional 40% sales growth which more than offset this. 40% sales growth from one of the world's biggest companies.
Amazon already has 50% of America's e-commerce market, but groceries are the next big thing for Amazon. They have 24% of that space in the US and are expected to subsidise the service with free deliveries to establish a dominant market share.
Number 3. Apple. Apple are bringing in cheaper products like the 5G enabled SE range, with which they hope to tap into that massive segment of the world market which can normally only afford an Android phone.
But software is the key to future success for Apple. Apple needs to monetize the software their customers use. Their customer base is attached to their phones, but limited cash was flown to Apple in between handset purchases, which for the average customer is a 4-year gap. So Apple have been developing software like Apple Music and Apple TV. We see them expanding their software and services going forwards to lock in their customers to a subscription model.
Number 4. Netflix. Netflix's future potential will come from the death of broadcast television. Netflix also massively undercuts old-fashioned satellite and cable services on price. We see a lot of potential for Netflix to raise their prices in future and further increase their margins.
Number 5. Alphabet. aka Google. Google dominates the internet, but there are still loads of avenues for expansion, such as into the cloud and communication services. But an exciting expansion currently under development will be into driverless cars. As for now, it's unclear if this will work, but in 30 years' time, if everyone is being ferried around by Google car pods, the early signs were on display for all to see in 2020.
Number 6, Microsoft. An honorary mention to Microsoft, which is not an official FAANG stock, but really should be. Check out our episode, linked below, for an in-depth look at why Microsoft and Amazon should be in everyone's portfolio.
Question of the day, does everyone need to invest in FAANG stocks? Let us know in the comments section. Thanks for watching! On this channel we talk about personal finance, investing and all things money. And if you want to see more great content, please click the subscribe button below.
This is moneyunshackled.com. See you next time.